Welcome to our weekly show focusing on the key macro trends affecting FX and the broader markets. So today we're going to look at a really important theme that could provide investors with a better portfolio hedge than the traditional long bond allocation. It revolves around what's happening in the energy sector, and it's driven by an idea from Louis Vincent Gave of GavCal. Now let's start with the traditional approach to hedging. For many of the last 30 years, an allocation to bonds was investors' go-to hedge, often expressed as a 60-40 portfolio of 60% equities and 40% bonds. During periods of market turbulence, investors would seek safety in bonds, pushing their prices up, which would then partially offset the losses in their equity allocation. Additionally, policymakers would often respond to periods of market strife with rate cuts, reinforcing the expectation that bonds would rally during these periods. And in fact, bonds rallied spectacularly during the dot-com bust of 2000 to 2002 and the great financial crisis of 2008. But, and it's a big but, this relationship has reversed in recent years. And that's what I want to focus on here. You see, during the inflation scare of 2021 to 2022, both equities and bonds fell at the same time, creating losses throughout many investors' portfolios. Additionally, many investors were also long equities that acted in a similar way to bonds, so that when bond prices fell, these equities underperformed. All this means that today the starting point for bond prices are much lower, and so currently they do have more room to rally again during periods of uncertainty. In addition, expectations have also been rising that the Fed will cut rates into 2026. But the problem is that these expectations for lower interest rates have not uniformly translated into lower yields. In fact, shorter dated yields such as the 2-year have fallen much further than longer dated yields such as the 10-year. And this widening gap between 2-year and 10-year yields is referred to as the steepening of the yield curve. Now, this is crucial to be aware of because, as we pointed out a couple of weeks ago, recessionary events are usually preceded by a steepening of this part of the curve. Of course, there are a multitude of reasons why this might be happening today, but one of them is that the bond markets may be sniffing out an increased risk of inflation in the future. And at a very simplistic level, inflation and commodity prices, especially energy, tend to track each other. So if the bond market is now highlighting that threat of inflation, maybe we should think about an allocation to equities that might perform well when inflation is rising and other equities are doing poorly. In that context, it should come as no surprise that the US energy ETF has a reasonably tight relationship with crude oil prices. Additionally, we're in a world where energy requirements are increasing, and much of this is being driven by the explosion of AI and the growth of data centers. Bitcoin is also increasingly sensitive to inflation risks, suggesting that the energy sector is also a decent hedge to crypto. So what could all of this mean? Well, one scenario is that if inflation risks are rising, then energy stocks should outperform, providing some defense to portfolios that might be overweight in tech shares or crypto. And this is definitely something to think about when it comes to doing your own research. And with that, now let's look at some of the questions that we've been getting from our viewers.
Okay, so the first question, and by far the most popular this week, is all about the US Federal Reserve cutting rates. And the question is this because of fears of a recession?
Well, if anything, the risk of recession has actually been falling, according to the New York Fed's own recession probability indicator, although this did give a false alert through much of 2024. You see, the real problem for the Fed is that the labour market is starting to deteriorate, but it's difficult to identify a clear pattern because of the distortions created by AI. The Fed probably actually shouldn't be cutting rates based on the performance of the equity market over the last 12 months, but there are sufficient uncertainties in the jobs market and stresses in the funding markets to allow policymakers a bit of leeway. But it is unlikely that they're cutting rates because they think a recession is imminent.
So next up, and kind of related to what we've just talked about, the question is, will rate cuts fuel another leg higher in risk assets?
Now obviously rate cuts helps particularly with sentiment, but it's not just the cost of capital that matters. It's also the availability of capital. If interest rates fall, but longer dated yields rise, then the benefit of low rates could be fleeting. On their own, low rates do not fuel market rallies, and this was perfectly illustrated in 2008 when rates were rapidly cut and yet the equity market continued to crash throughout the end of that year.
And the final question, and this is a big one, is will the Fed restart QE?
Well, first off, what is QE? QE, or quantitative easing, is generally thought of as the systematic buying of bonds by the Federal Reserve. Now, expectations for QE have been increasing because of recent funding issues and the creep higher in those longer dated yields. One of the main causes of concern is the size of the US government refinancing bill and the potential stresses from rising interest costs. Some form of QE or QE light is expected to prevent stresses rebuilding through 2026. Okay, that's it for this week, but before I close, please remember that none of this is investment advice. It's for education and engagement purposes only, and it's to help you with your own research. When investing, understand your own risk tolerance, time horizon, and investment objectives. And then invest accordingly.